Hey everyone, welcome back to Corporate Decoder, the place where we unpack big company secrets. And today we've got Mastech Digital Incorporated filing their latest quarterly report. And let me tell you, there is some interesting stuff going on under the hood, especially with their numbers looking a bit dicey this quarter. Alright, so this is Mastech Digital Incorporated's report for the quarter ending the 30th of September. 2025, it is basically a snapshot of how the company is doing financially over a 3-month period. Think of it like a quick checkup for a business. Looking at the main financial results, the top line revenue for the 3 months ending the 30th of September 2025 was about $48.5 million. Now that might sound like a lot, but it is actually a bit lower than the same period last year where they pulled in just over $51.8 million. That might not seem like a huge drop, but if you break it down, they're at staffing services, which is their bigger segment, saw a slight dip, and their data and analytics services segment experienced a more noticeable 16% drop. For the longer 9-month period, revenues were down about 2%. This means they are bringing in less money overall compared to last year. This drop in money earned directly impacts their gross profit, which is the money left after paying for the direct costs of providing their services. For the 3 months, gross profit fell from $14.8 million last year to $13.5 million this year. The company explains this is partly due to some severance costs they had to pay out as part of a reorganization. Without that, the percentage of revenue they keep as gross profit remained pretty steady, around 28.5%. However, their data and analytics services segment saw its gross margin shrink quite a bit, which is a concern. Then we look at the costs of running the business, like marketing and salaries for the folks not directly working on client projects. These expenses actually went up slightly from $12.3 million to $12.6 million. What is interesting here is that a good chunk of this increase is due to things like severance costs and expenses related to moving their finance and accounting teams to India. While these might be time or transitional costs meant to save money in the long run, they made the current quarter look more expensive. When you put all that together, the income from their main operations took a hit. They went from making a pretty healthy $2.4 million in operating income in the third quarter of 2024 to just about $820,000 in the same period of 2025. For the 9 months, operations income dropped significantly from $3.7 million last year to a loss of over $1 million this year. This really shows that even with those restructuring costs, the core business is not generating as much profit. And the bottom line, net income. For the 3 months ending the 30th of September 2025, they reported a net income of $941,000. That sounds good, but for the same period last year, it was $1.8 million. So about half the profit. For the 9 months, they reported a net loss of $363,000, compared to a solid profit of over $3 million in the prior year. This swing from profit to loss over 9 months is a significant red flag, suggesting challenges in turning their business activities into actual profit. Now let's peek at the balance sheet, which shows what the company owns and owes at a specific point in time. As of the 30th of September 2025, they had about $32.7 million in cash and cash equivalents. That is a good amount and has actually grown from the end of 2024. This tells us they have the cash on hand to operate and meet their short-term obligations. Their accounts receivable, which is money owed to them by clients, decreased slightly. This is generally good as it means clients are paying them faster. Their goodwill, which represents the premium they paid for acquisitions above the fair value of identifiable net assets, remains high at over $27 million. They did write down some of it in the past due to performance issues in their data and analytics segment. This can be a risk because if the acquired businesses continue to underwhelm, they might have to take another hit to their profits. Total liabilities are around $24.6 million. That is not too bad considering their cash on hand. Shareholders' equity, which is basically what the owner's stake in the company is worth, is about $88 million. This is healthy and increased slightly from the end of the previous year. Looking at the changes in shareholder equity, we see the story of the past 9 months. There was a net loss for the period, which reduced retained earnings. They also had some stock-based compensation, basically giving away shares or options to employees, which increases equity, and they repurchased some of their own stock, which reduces equity. The company has been buying back its own shares, reducing the total number of shares outstanding and potentially boosting earnings per share. They continue to do this strategically, which can be a good sign if they believe their stock is undervalued. The cash flow statement is crucial, as it shows how cash is really moving in and out of the business. For the 9 months ending the 30th of September 2025, they generated $6.8 million from operating activities. This is up from $3.2 million in the same period last year. That is a positive sign, meaning their core business operations are bringing in more cash. Even with the lower reported profit, investing activities used about $369,000, mainly for capital expenditures like buying new equipment. This is a small amount and shows they are not making major investments in long-term assets right now. Financing activities were a bit of a mixed bag, using about $992,000. This was largely due to buying back treasury stock, which uses cash, even though they also had some cash inflow from stock options being exercised. Diving deeper into their segments, the Data and Analytics Services segment had revenues of $7.9 million for the third quarter, down from $9.4 million last year. The company attributes this to weaker demand and longer decision cycles from clients. Their new bookings, which is essentially future business they expect to get, also dropped significantly. This suggests a tough environment for this part of their business. The Bigger It Staffing Services segment brought in $40.6 million, down from $42.4 million. They mentioned fewer billable consultants working for them compared to last year. However, they did manage to increase their average hourly rate, which is a smart move to offset the lower volume. Looking at expenses, sales and marketing expenses for data and analytics went down in the third quarter compared to last year. This might be a response to the lower demand in that segment. Now, remember those severance expenses and the finance and accounting transition to India. Those are indeed showing up in the operating expenses, adding to costs in the short term. The company is hoping these moves will lead to long-term savings. Their income tax expense was lower this quarter, partly because their overall income before taxes was lower, and also due to some specific tax situations related to stock options and foreign earnings. Overall, revenue is down across the board compared to the prior year, and the company is facing some headwinds in both its business segments. The data and analytics part is seeing a tougher market with clients being more cautious, and even the larger It Staffing segment is experiencing some slowdown. The gross margin for data and analytics services, which is the percentage of revenue left after direct costs, dropped to 46% from over 50% last year. This is a bit concerning, as it means each dollar of revenue in that segment is less profitable. On the flip side, It Staffing Services actually saw its gross margin improve slightly to almost 25%. This is a positive sign that they are managing costs or getting better prices for their services in that segment. Interestingly, the company has been actively repurchasing its own shares. They even had a specific plan called a Rule 10b5-1 plan to manage these buybacks. They purchased a significant number of shares in the third quarter under this plan. This can return value to shareholders by increasing the ownership percentage of remaining shareholders and boosting earnings. Purse hair. And as always, the report concludes with the required certifications from the CEO and CFO confirming the accuracy and integrity of the financial information. So, what is the big picture here? Mastech Digital Incorporated is navigating a challenging market. Revenues are down, and profitability has taken a hit, especially in the 9-month comparison where they've moved from a profit to a loss. That drop in the data and analytics segment is a clear area of concern. However, they are managing their cash well, have a solid amount of it on hand, and are continuing to repurchase shares, which can be a positive signal. The company is also making some strategic moves to cut costs by shifting operations and optimizing its structure. These moves might hurt in the short term with severance and transition expenses, but could pay off down the road. The IT staffing segment shows some resilience with improving margins, which is good. The biggest risks here seem to be the continued softness in the data and analytics market, and the large portion of their revenue that comes from a few big clients, making them vulnerable if one of those clients leaves. The company acknowledges this concentration risk. In my opinion, Mastech Digital is in a bit of a transition period. They are making tough but potentially necessary decisions to streamline and save money, but the immediate financial results reflect those adjustments and a challenging economic environment. They need to show that these cost-cutting measures will lead to sustained profitability, especially in their data and analytics segment. For now, it is a cautious outlook, but the underlying cash position and the strategic buybacks offer some support. Alright, that is our breakdown of today's Mastech Digital Incorporated filing. What are your thoughts on the company's direction and these financial results? Let me know in the comments below. If you found this analysis helpful, please give this video a thumbs up and make sure you are subscribed for more. And don't forget to join our community on Discord. The link is in the video description. Thanks for watching, and we will see you in the next one.